one.
Afternoon, everyone. Thanks for joining us today. We're just going to give everyone kind of 30 seconds or so to join before we get started. Right, so while we wait for those last few to join, there's just a couple of kind of housekeeping bits to take care of. So firstly, the webinar is being held to coincide with the release of our quarterly reports, which were actually released a couple of weeks ago. I think this might be the first time we're not releasing them after the webinar. So also the session is being recorded, so we'll make sure that everyone does get a copy of that in due course. We had a number of questions already as part of the webinar sign-ups, but as always, if you do have any additional questions for us, you can just submit them via that Q&A function in Zoom. So we're going to get onto that towards the end of the call today, but we'll try and get through as many as we can. Before we run through today's data, we do have a number of poll questions that will be appearing on your screen now. So just to note, these can be minimized. So question number one, what are your PBSA rental growth expectations for the 26-27 cycle? Question number two, similarly for HMO, what are your HMO rental growth expectations for that cycle? And then thirdly, how has your overall view towards the student accommodation market shifted over the last 3 months? So you can go ahead and answer those or minimize that poll. And on that note, we can crack on with today's presentation. So Mr. Richard Ward, over to you.
Calum. I appreciate a lot of people are familiar with what we do on the call, but for those that are new to these sessions, by way of a very quick intro. So to kind of break our business into 3 parts, really, we have 3 distinct areas. We have the listings platform, so StuRents.com. That's been around since 2008, and we list, roughly speaking, about 750,000 beds nationwide. We are also a leading provider of property management software. That's via a separate brand called Concurrent. And we're close to executing about 4 billion in tenancy value for our customers. And in terms of the StuRents intelligence side, we obviously leverage those 2 platforms, supplement the data where we need to provide highly granular data to a real range of stakeholders within the student market. I know, again, there'll be quite a few on the call who did attend our 3rd annual summit, which took place 2 weeks ago at Fulham Pier. For anyone that's interested in signing up to the waiting list for next year who hasn't done so already, you can scan the QR code. But really well attended event. We went through a lot of the latest industry trends, a lot of pertinent themes, and some great insights from the range of panelists that we had during the day as well. In terms of the presentation for today, for those that were at the summit, there will be a few slides that you'll recognise from the day. But we do also have some additional insights we'll cover as well. So do hang around for those if you can. So in terms of today's topics, we are going to look at those headline dynamics in terms of supply and demand before moving into the concept of build to rent. Again, that's a topic we explored during the summit, but that has become more and more relevant in today's environment. So we wanted to look at that in a bit more detail. We'll then give the latest updates to PBSA leasing velocity before moving on to the latest updates from a planning perspective. And then we'll finish the session by, I guess, doing a bit of a forward-looking perspective and working out what might the future hold for the sector. As Calum said, we have already had a bunch of questions submitted during the sign-up process, but we'll try and get through as many Q&As after the presentation today as well. But as I say, do submit more questions if you have those. So let's start by revisiting the latest fundamentals from a supply and demand perspective. Again, many will be familiar with how we look at supply and demand in the market, but to explain the chart on the right briefly, what we typically consider is the change in demand over time, and that's represented by the navy line in this particular example, versus the change in supply over that same period. This particular analysis is looking at everywhere outside of London, so it does not include London, but it allows us to understand, is demand outpacing supply or vice versa, and how is that changing over that particular time period. Now, what we can certainly say is over the last 2 to 3 years, we have seen a slight decline in the number of full-time students in the UK. We've explored that in previous sessions in a lot more detail, so we're not necessarily going to dwell on that today. But primarily that has been driven by a decline in postgraduates and specifically international postgraduates. And that really is contributing to that reduction in demand, which we can see post kind of 2022 as represented by the navy line. Over the same period, we have seen PBSA supply specifically continue to grow over that period. And what that essentially means is the spread between that demand growth and supply growth has materially narrowed over the last 2 to 3 years. If we cast our mind back to probably the 22 cycle and going into 2023, that's when the sector was seeing very strong leasing velocity and double-digit rental growth. And that very much correlates to what we see in this particular chart, where again, during that time, the spread between demand growth and supply growth was at its highest. Going one step further, and what this particular chart is also now considering, is the role that build to rent is having within the analysis. So if we were to look at those two orange lines, the bottom line is including just PBSA growth only. And again, that's the dashed orange line in this case. Even on that basis, as I mentioned, the supply and demand spread has materially narrowed. But if we start to, as a sector, overlay a proportion of the build-to-rent market on top of that, and in this case, we're considering about 30% of build-to-rent beds, you can see the outlook does change again. And actually, on that basis, it suggests, on the face value at least, that the growth in supply has now potentially outstripped growth in demand. And that really resonates with what we're seeing from an occupancy and leasing standpoint, again, for the last year or two. So really the key takeaway there is, as a sector, it's now absolutely critical that when we're looking at supply and demand, and that goes at a locational level as well, we have to consider the role that build to rent is playing. That does make it a lot more complex, and that is a challenge for the whole sector. It's something the sector's not had to deal with necessarily, particularly if we go back 4 or 5 years. But as I say, it is now absolutely critical. Following on from that, again, something we touched on a couple of weeks ago, but for those that weren't present, we wanted to explore the impact of affordability in the market. There are a lot of actually still positive signals around particularly undergraduate growth, and particularly domestic undergraduate growth, which has been positive. But there have been a lot of stories in the last few months around the rise in live-at-home students, which we'll come to shortly. But we wanted to kind of explore some of the reasons behind that. Now, a lot of the time within the sector, when we are hearing stories about affordability, it is typically focusing on the maximum maintenance loan. However, in reality, the vast majority of students do not receive that. And actually what's quite shocking is that if you're a student coming from a household with one working parent working just above the minimum wage, you will not receive the maximum. So using that as a benchmark is not representative of the majority of students. Now, on that basis, what we've decided to do is adjust that maintenance loan based on a household income of £40,000. So still not extravagant by any means, but gives us at least a more reflective benchmark to work off. If we do that, we can then compare it to rent in either the HMO market or PBSA market, and we can see those are two lines represented on the chart, and then essentially take one from the other. So the chart is depicting the balance of the maintenance loan once rent is taken off. And what we can see is that since 2021, that balance has materially fallen. You're looking at, depending how you measure it, well over half in some cases, so a 50% reduction in that balance. And that is significant. And really that relates again to that period when we saw double-digit rental growth, and maintenance loan growth was by no means keeping track with that. And that again is why we've seen that pretty rapid erosion in that balance of the maintenance loan. More positively, for the last year or two, with rental growth moving back to kind of more historical levels, that has somewhat stabilized. But the challenge for the sector is there's no way or no mechanism, at least, for that to be reversed necessarily. So we'd either would have to see negative rental growth, or a maintenance loan increase tracking well above that. And again, we don't quite know if that's going to happen, but it seems unlikely to a material degree at least. So that really highlights the challenges around affordability for domestic students. Obviously, international students are not immune to this. Again, we've explored that in more detail in previous sessions, with Chinese students clearly having higher budgets on average. But again, even some of those demographics have faced their own issues back home, whether that's a tougher jobs market or perhaps currency fluctuations. So again, they are not fully immune from that affordability impact as well. As a result of that, what we have seen is an intention to live at home that has risen pretty significantly over that same period. And again, you can see from these charts, they're all very much interlinked. So strong leasing velocity around 22, 23, a degradation in the balance of the maintenance loan, and therefore an increase in the number of students who are deciding to live at home. We can see the impact. So we're looking at about a 9 percentage point increase since 2016, so pretty significantly, and most of that increase coming in the more recent years. It is worth noting this data from UCAS specifically looks at the intention to live at home, so it's not absolutely guaranteed, but I think the trend is still very much noteworthy. To put some numbers behind that, so we're looking at about 22% in 2016, up to about 31% in 2015 for 18-year-olds. So again, pretty significant increase. In terms of could that stabilize in the near term, as I mentioned, if we do see rental growth move more in line with maintenance loan growth, that could help support that and help stabilize those figures. But that's something we'll have to keep a close eye on. In terms of the other knock-on impact from that same trend, it's the rise in the proportion of students who are having to work whilst in study. This data is actually based on a report released last year. But what it shows is that significant increase in the proportion of students who are in some form of paid employment. And that's essentially gone from around about a third of students in 2016 up to about 2/3 for the most recent period. So again, a noticeable shift in the proportion of students who are either deciding to live at home, or if they're living out of home, having to then work to offset, again, some of those increases in costs. From a, I guess, university experience perspective, that will fundamentally shift that experience for students. And I think that's something the industry could potentially look to communicate better. So perhaps communicating to prospective students the benefits of living away from home, personal growth, social experiences, and so on, which they may not get if they are deciding to stay in the parental home. A few other points worth mentioning, just to kind of refocus on the latest search trends that we're seeing within the platform. If we focus on the Q2 period, which is represented by the navy bars in this particular case, and for clarity, Q2 actually refers to January to March just gone. We would classify that as Q2 within the 26-27 cycle. But we can see demand has started to shift slightly towards smaller sizes, so away from your larger cluster sizes. And if we look at the figures there, we're looking at about 58-56% searching for 3 beds or more, down from about 92% in the previous quarter. It's worth mentioning that is pretty much expected. That's a trend we do see play out in most years. And primarily the reasons behind that are that domestic students typically house hunt in the Q1 period, so very early, and are typically house hunting in groups, so therefore looking for your 4, 5, and 6 beds as represented by the chart. And as we progress through the letting cycle, you start to see more interest from international students who are on average looking for smaller cluster sizes. What's also worth picking out from that particular chart is actually when you start to go beyond 6 beds, the level of demand for both periods is actually relatively low, which is worth bearing in mind. Sometimes we do see planning applications being submitted, for example, for very large cluster sizes. Obviously, there are issues around trying to make schemes viable, but equally from a marketing standpoint and demand standpoint, the demand for those larger clusters is actually relatively low in the grand scheme of things. Something else we actually have added very last minute is the latest data from QS and looking at their world rankings. This data was actually released this morning, so we only have one slide on this, but we'll be looking at this in more detail in the coming days and weeks. But we wanted to kind of highlight some of the big movers and shakers, I guess. So this particular chart is looking at each individual university, and we've just highlighted the main movers. And you can see their change year on year in rankings. So positively, you have, for example, Manchester Met seeing a pretty significant increase in their rankings, whereas at the other end of the spectrum, you have University of Plymouth, which has seen a pretty noticeable drop in the rankings. We know from an international demand perspective, it is closely watched, so it is worth bearing in mind. Two other ones worth picking out or commenting on. One is the University of Southampton. So interestingly, actually, from the data released today, that's now fallen out of the key top 100 category, which we know is, again, very closely watched by the international student market. So that's one that's worth being aware of. And positively for Imperial, they've leapfrogged Oxford and Cambridge. So they are now ranked number one in the UK, which is interesting to note as well. So again, some movers and shakers. We'll do a bit more of a deep dive into this in, again, the next week or so. But given the data is released today, we wanted to just quickly highlight that. So moving on to that topic of build to rent, which I mentioned, and again, it's something we have discussed in previous sessions, again, something we covered at the summit 2 weeks ago. But for the benefit of those that weren't there, we wanted to highlight the next two slides. Now, I think what's important to recognize is that as an industry, as I mentioned earlier, if we're not looking at build to rent within our analysis, we are not getting the full picture. Now, what this particular chart is highlighting is if you look at each of these markets and you look at the number of beds delivered since 2020, so relatively new stock, we can compare what that growth looks like, either inclusive or exclusive of build to rent. So if we take London as an example, just focusing on the delivery of new PBSA, you're looking at about 20,000 PBSA beds delivered since 2020. If we overlay a proportion of the build to rent market on top of that, and again, that's based on a 30% uptake, then that figure, as you can see, jumps to somewhere close to 33,000. So again, a pretty noticeable difference from a supply growth perspective, depending on whether we are including build to rent or not. If we look at somewhere like Birmingham, possibly Manchester as well, Manchester, for example, jumps from about 4,700 new beds added over that period to close to about 7,500. So again, a pretty noticeable difference depending on whether we're including or not. Leeds is one we'll explore in a little bit more detail next, but again, similarly, jumping from less than 10,000 beds added to more than 12,000. So again, as I say, we're not getting the full picture if we're now not including build to rent within that analysis. If you look at some markets, I believe it's Cardiff from memory, whilst the absolute numbers are relatively low, which is why they're not included in this particular chart, PBSA growth is about 50% of the story. So again, we're missing 50% of that growth if we're not including build to rent within that analysis. Obviously, the risks here are that we could see investors or stakeholders enter into markets believing they are significantly undersupplied, for example, because build to rent is not being included. And perhaps the reverse is true, or perhaps the opportunity is not as straightforward or obvious than it may seem on face value. It's also worth noting this analysis only includes kind of headline build to rent. It's not including co-living, which again complicates that picture even further. And we know co-living is of interest to many at the moment as well. So taking that one step further and focusing on Leeds. Why Leeds? Well, we know that was a market where we started to see the impact play out, particularly 3-4 years ago, and kind of really where the issue reared its head first. This is taking that same analysis we saw at the start of the presentation. So again, tracking changes to demand versus changes in supply, and then just modeling 3 different growth scenarios from a supply standpoint. Again, Leeds has been similar to the national trend, has seen a reduction in demand post-COVID. That seems to have stabilized a little bit for 24-25. We don't know for sure, given the issues and the time delay related to HESA. But even on that basis, if we were to look at supply growth, just including PBSA, which is the dashed orange line, we can see again that gap has materially narrowed. But on face value, on that basis, cumulative changes to demand are tracking slightly above cumulative changes in supply, albeit tougher than where it has been in previous years. If we then start to model an uptake of 20% in build to rent or 40% in build to rent, you start to get quite a different outlook. And even based on that 20% figure, again, it's a market where perhaps supply growth has now actually outstripped demand growth. So again, I think the challenge for the sector going forward is how we're going to start to model the inclusion of build to rent into analysis and the assumptions that are made and how that impacts the output. But again, key takeaway here is if we're not looking at build to rent with the analysis, we're not getting the true picture, which again can be quite different. Moving on to all important occupancy next and tracking how that's developing this year. So each line represents a different letting cycle. We can see if we focus on the orange line, so 25-26 cycle, I think again it's pretty well recognised that the industry was harder last year and the end position was down. So the market was both slower and lower in the end, which again correlates to what we saw earlier from a national supply and demand standpoint. Looking at the latest leasing velocity for this year, and again specifically for PBSA, we're tracking there or thereabouts compared to last year, down marginally, which we'll explore in a bit more detail shortly. So again, similar situation to last year, at least so far. Taking that one step further, what this particular chart is looking at is the year-on-year spread in performance. So again, for the 25 cycle as well as the current 26 cycle. Starting with 25, so last year, we can see that, I mean, throughout the whole cycle, it was down, and we saw that because the end position was lower. But the spread was actually largest around about April time. So there was, roughly speaking, just under a 14 percentage point difference in April last year. That then did improve as the cycle progressed, but as we just saw by October, the market was still down year on year. I think looking at the data for the 26-27 cycle, I think the points that are worth highlighting is that the spread has actually started to narrow and improve for the last 2 months. So if we focus on February, for example, down about 2 percentage points year on year, and then that has slowly reduced. And as of April, again, that's reduced once more. If that trend continues, that means that we could actually find a position where over the next month or two, we could go positive. We don't know for sure yet, but again, that's one we're going to keep a close eye on. But the fact that we've seen that year-on-year spread narrow already, I think is at least somewhat of a positive sign. In terms of performance at a locational level, we know that varies significantly. This is picking out 9 locations. We do report on many more, but just comparing that to the national average for the current cycle, we can really see the difference in performance there from this chart. You've got some markets that are tracking well below the national average, and as of April, about 30% let, and then you've got some locations that are more than 50, even 60% let as well. So as always, massive variance at a locational level. And if we were to go one step further than that, even at a intracity level or individual scheme basis, again, huge variance between individual schemes within those markets themselves as well. Moving on to planning updates next. So focusing on the level of planning activity. This particular chart is tracking the number of beds submitted or approved on a rolling 12-month basis, submitted being the orange line, approved obviously the navy line, as we can see. I think broadly speaking, activity does remain low. Somewhat interestingly, you can see there has been a bit of a spike in the number of beds approved more recently, but as the slide depicts, a lot of that was related to relatively few large schemes in London, Birmingham, and Glasgow. You can see about 60 or more than 60% of beds approved in Q2 were in those 3 locations alone. From a planning activity and submitted basis, again, the orange line has been consistently falling. And for the first 3 months of this year, you're looking at more than a 50% reduction in the number of beds being submitted. So planning activity is still low, historically speaking, and the trend is again going down in terms of number of beds being submitted. There are more than this, but as always, just to highlight some of the more notable schemes being submitted or improved. I'm not necessarily going to read these out. You can see these on the screen. But there are some big ones. If we look at those being submitted, almost 800 beds in Castle Street on London, a relatively large scheme in Durham as well being put forward. And on the approval side, again, some pretty big projects, and that one that's over 1,000 beds in Coventry does somewhat stand out, which is interesting. Equally, quite a few beds being put forward in Nottingham still as well. In terms of activity on a local level, as we've just seen, it does remain low from a national perspective, but the activity is very much skewed and remains skewed to relatively few locations. So if we look at the number of beds being submitted in the last 6 months, for example, around 75% of those beds being put forward are being done so or have been done so in 5 locations. So again, a very much concentrated planning environment. We know viability remains an issue. There are only certain locations where existing rents make development viable. But again, noteworthy that is very, very much skewed to relatively few locations. And we'll see the impact of that in a minute as well in terms of supply growth. Something else we wanted to very quickly focus on is cost inflation. So this is data based on what they classify as the All New Work Construction Index, and really wanted to highlight how that has shifted in the last few months specifically. We can obviously see the massive spike going back to 2021-22 period, and that index hasn't kind of materially reduced since then. But in more recent months, we have again found a situation where we're in a inflationary environment. Hard to know if that's related to conflict in the Middle East. It's no doubt a contributing factor. That seems to be drawing to a close, but you can never quite be 100% certain. So the spike more recently could be limited. But I think the main takeaway here is going back to what we saw a few moments ago with regards to the number of beds being submitted. All these factors and hurdles mean that actually going forward, the pipeline is going to remain restricted. There is going to be limited delivery of new beds, and equally the number of beds being put forward is also going to remain relatively low. What does that mean in terms of supply growth? No surprise, it does remain restricted as well. If we look at the numbers for this year and last year, they are down significantly compared to, say, 2019. And this very much correlates to the chart we saw a few moments ago with regards to planning activity. For 2026, these numbers are not yet finalised. They are subject to change, but we're likely to find the number of beds being delivered this year down possibly marginally compared to last year. As I say, if we then project that forward, given the slowdown in the number of beds being submitted, at a national level, we're not expecting any material increases, and actually there's an argument to suggest the number of beds reaching practical completion will remain low and could actually decline further still. Having said that though, as we'd expect, as we just saw from an activity standpoint, where beds are being delivered, again, is skewed to relatively few locations. And again, that just correlates to where the activity is taking place. But if we look at this year, for example, around 70% of that growth is in 5 locations. So we can see London, Bristol, Birmingham, Manchester, and Glasgow is where the majority of those new beds are, in fact, being delivered. There's a bit of a long tail, but as I say, a significant proportion being delivered in those 5 locations. So that just leaves me to kind of finish off and look at the outlook for the sector. So really going back to the start of this presentation and projecting these numbers forward, we wanted to not necessarily predict the market, which we know is going to be extremely difficult, but instead give some insights in terms of what demand growth needs to be to offset supply. As I said, supply growth is likely to remain low, could be even lower than what we're showing here. But equally, as we've discussed today, there is a significant role being played by the build-to-rent sector. So this particular chart, as I said, is what we saw earlier. We've then projected forward a proportion of the pipeline, both for PBSA and build-to-rent. If we focus on the analysis just taking into account growth in PBSA, which again is the dashed yellow line in this particular case, in terms of the required rate of demand growth needed to offset that increase in supply, you're looking at about 0.5%. So not significant and actually relatively low. Now, again, as we've mentioned, once you overlay a proportion of the build-to-rent market onto that, the required rate of demand growth jumps to close to around 1.5%. So there is a noticeable difference in terms of, let's say, the required rate of demand growth. However, it's still relatively low. And actually, if you look historically speaking, the market has pretty consistently been delivering more than 1.5% demand growth, albeit more recently that's not been the case. So for me, I guess the positive from this is the market can shift, as we've seen in the last few years, and actually it wouldn't take much for those fundamentals to improve. The big question is, are we going to see that return to demand growth? And that's something we're all kind of trying to work out. A few other points we're just highlighting. We're not necessarily going to go into lots of detail today. I think scheme withdrawals are obviously something that the market needs to be aware of. There are going to be certain assets that simply exit the market, and that's going to be a positive for operators and investors. Live at home rate growth, we have touched on earlier. I think the key takeaway from that is that even if we don't see that number grow, it's going to offset some of the previously expected benefits from the rise in 18-year-olds. So again, the interplay between that is going to be interesting to see how that plays out. University mergers, actually changes to legislation. There's been some announcements in the last few days in particular that are worth bearing in mind. But I think, again, those are two factors where we don't quite know the impact yet, but we are going to obviously keep a very, very close eye on those. So to summarize, I think leasing velocity from PBSA standpoint, I say tracking closely to last year, albeit very marginally down, although we have seen a slight improvement in the last few months. I think affordability is one that's has been spoken a lot about in the last 6 months or so, but that is a trend that's not going away, given the factors we've explored today. As I've mentioned multiple times, the sector is more complicated and nuanced, and I think it's been in recent memory. Build to rent, obviously a contributing factor there. In terms of future delivery of beds and the pipeline, they are both expected to be restricted. But as we've seen, it's definitely worth bearing in mind where that activity is taking place, because it's not evenly distributed. And then finally, as we've just mentioned, only minimal demand growth is required for the market to improve. It's just a big question of whether we are going to see that in the next few years. So lots going on. Again, hopefully there's enough there for those that attended the summit 2 weeks ago that's of interest as well. And at this stage, I'll hand it back to Calum, and hopefully we'll be able to answer some of your questions.
Great. Thanks for that, Rich. Always nice ending on a bit more of a positive note there. So
I tried today. Yeah.
Yeah. Before we go on to some of the Q&As, Rich, are you able just to pull up the
Yes.
poll results from earlier?
Let's do that. Bear with me. I will end the poll and share the results.
So hopefully this should also pop up on your screen. But the majority of you for PBSA rental growth expectations expect kind of around that 1 to 2% mark. So obviously not that kind of double-digit expectation that that we've been seeing over the past few years. So actually, no one voted for 5% plus. So that's obviously quite interesting there. Secondly, HMO rental growth, again, similar numbers, a bit more of a spread on this one though. So around 40% of you voted for that 1 to 2% number. But a few more people optimistic here that these growth levels could reach 3 to 4, upwards of 5%. And thirdly, how has your overall view towards the student accommodation market shifted? So around 18% of you more optimistic, 28% unchanged, and 54% more pessimistic. So hopefully after Rich's presentation, that may have changed. So hopefully a bit more optimism in the room after that. But yeah, thanks for answering that poll. So on to the questions. So we're just going to go through some of the ones that had been pre-submitted. If we have time, there's also been some Q&As that have come in, so we'll just try and get through as many as we can. So firstly, so are cashbacks, third-party leasing fees, and more flexible terms affecting NOIs and falsely protecting headline rents? So Rich, I don't know if you've got any comments on that one.
Yeah, so I know obviously you and I have had lots of conversations. I mean, going back probably multiple years now, to be honest, around headline rents and revenue. I wouldn't say necessarily falsely, but I think certainly looking at headline rents is not providing the full picture. Actually, a chart that we went through during the summit a couple of weeks ago was looking at exactly this topic. So essentially tracking headline rent versus revenue at a scheme level. And essentially there's a complete disconnect. There is zero correlation between the two. It sounds obvious, but key contributing factors to that are occupancy, clearly. Obviously, any incentives, but also tenancy length. So what you can actually see if you dive into the data in detail is that you could get two schemes with exactly the same headline rental growth and the complete opposite in terms of revenue. So yeah, I wouldn't say necessarily falsely, but I think certainly looking at headline rents is certainly not giving the full picture. I think to put a positive spin on that, where that starts to become quite interesting is that presents risks, but also opportunities. I think if there are certain markets whereby you might see headline rents, let's say, not increasing as fast as you would like, but you're starting to see schemes increase tenancy length on average. Renters' rights may complicate this a little bit, but if you start to see some of those tenancy lengths increase, you're actually going to get a bigger benefit from that than the headline rental growth. So, again, as we've been saying for many years now, headline rent is only one piece of that puzzle. So, yeah, certainly worth bearing in mind those other factors for sure.
Okay, thanks, Rich. So up next, so the renters' rights question here. So the RRA impact to HMO markets since the law began. Is there anything that the research team is witnessing? So I've got a couple of thoughts on this one. So I think the honest answer is it's still probably too early to say we've seen a clear, like measurable impact on the HMO market. I think the main thing we've been watching is seasonality. So before the Act came in, there was that view that student HMOs might have to push the letting cycle back. A lot of the HMO activity starts like pretty early, right? October, November time for the following academic year. And that was mainly linked to, the grounds for a timing point. So if agreements can't be signed more than 6 months before the tenancy starts, then there was the theory that HMO lettings might shift later on in the cycle, maybe kind of January time. So what seems more likely at this stage is the market is going to try and preserve the existing cycle. So, students may still search, commit early, but more of a reservation process first, and then the formal agreement, completed later on down the line. So I think from our side, we're not seeing evidence of a major shift in the HMO seasonality just yet, but I think the bigger unknown is what happens later on in the tenancy. So like students, they've got more flexibility to serve notice. So we need to see how many actually use that right. Whether landlords respond by changing the contract lengths or the start dates or pricing, we're not really sure yet. So in short, so there's no clear structural impact just yet, but I think key things to watch out for are definitely like HMO seasonality and that student notice behaviour, essentially.
Yeah, absolutely. I think we'll keep a close eye on that probably over the next 6 months or so, I guess, in terms of are we starting to see any material numbers start to serve their notice early. So we are keen to keep a close eye on that. Interesting, going back to the affordability point that I raised earlier, I think you're going to find this situation where you're going to have some domestic students who, quite simply don't want to go home and want to continue living with their mates at university. So that's kind of one group. You might find another group where if they are being supported financially by parents, for example, and the parents may insist their offspring serves notice early to save some money. So I think those are the two factors. But again, we'll have to see what happens to those numbers. As we progress through the cycle, really.
Yeah. So another question here: with some markets beginning to slow down and complain about vacancy rates, have there been any identifiable trends, or is it all down to pricing and location?
Yeah, good question. I think if you look at going back to last year with the full letting cycle, most markets were down, so it was relatively nationwide. I think again a lot of that can be attributed to that volatility we saw in postgrads. We know some universities did see double-digit declines in international postgrads. That would have certainly impacted some more than others. I think in terms of trends, there are certain locations clearly where, Nottingham's one that we've referenced a few times, where again, that is a market that has seen an increase in supply, not matched by increase in demand, and therefore occupancy takes a little bit of a hit. I think looking at it at a scheme level, so far at least, we've not really identified any meaningful trends. And the way we sometimes explain this to those investors and operators we work with is you could, in theory, have two schemes that are very similar, similar price, similar location, for example, but the occupancy could still be completely different. There are so many contributing factors. So, is it related to something as simple as the general manager on site who really helps with the rebooking process? Is it some of the operational challenge that's being experienced by one operator versus another? Is it the booking platform? And all of that can really muddle that picture and make it really hard to identify trends related to things like, is it a certain price bracket that's performing well, or is it a certain location? Again, difficult to unpick those specifics. So we're going to keep a close eye on it. Again, it's something we can potentially explore in future sessions, but yeah, to date at least, it's not been an obvious trend related to a particular subcategory as such.
Okay, yeah, thanks, Rich. On to the next. So, how has recent increase in fees for domestic students affected demand, if at all? So I think I'd split this into two parts. In terms of the headline domestic demand, I don't think we've seen any clear evidence that a fee increase has materially changed like behaviours yet. I think participation rates have remained like fairly stable. So at this stage, it doesn't look like it's going to have, be a major demand shock. I think where it does matter though is affordability. So for students, it's not just tuition fees in isolation. So it's the total cost of going to university. So some locations, the annual cost of accommodation can actually be higher than the tuition fee itself, and we've seen that. The difference is with tuition fees, they're usually funded through the loan system and repaid later, depending on earnings. So rent is a more immediate cost. It's got to be paid while a student is studying. So, and then from an accommodation perspective, I'd be more focused on the all-in costs, so rent, bills, food, travel, day-to-day living. Um, I guess the key point here is there's not a clear impact on domestic demand yet, but affordability is definitely becoming, a bigger driving factor in this. So I think over time that could mean, more students choose to live at home, where they do have that option. But yeah.
I think what was interesting, I was at a recent the Investor in Students conference again a couple of weeks ago, last week, and actually asked, they had a student panel, and actually asked the question to that student panel, if there was an option to take a 2-year degree to save some money and to kind of get into the jobs market more quickly, would you do it? It's a sample of 4, so make of that what you will, but they all said yes. So that's an interesting point, that's desire to reduce that cost and actually do a degree that is shorter in length to help with that. This, I mean, again, it's a very small sample, but there seems to be at least some appetite to do that. I think some universities have more recently decided to take that route with some courses. Again, that's one that's worth keeping on. There's lots of trends going on at the moment that, let's say, make it a very complex
Yeah.
market at the moment.
Yeah, I'm just got to be conscious of saying we're not quite sure yet on every single one of these
It's
questions
fine.
as well.
Yeah.
But yeah, there's a lot to kind of play out over the next couple of years. So we've got another question about renters' rights. So with Renters' Rights Act now in force and the PBSA being excluded, how will the PBSA and BTR markets differentiate themselves when seeking to attract to the same tenant?
Yeah, I think we may have had a similar question we might come back to that's been submitted as well. Um, it's interesting. I think realistically, the build-to-rent market in an ideal situation wouldn't attract students. I think we know that's not primarily their business model. I think obviously some schemes have had to take on their students to help with initial lease ups, which I'm fully aware of, and that's impacting some markets more than others. I think looking at one of the benefits that PBSA does have, I mean, the clues in the name, is built specifically for students. I think leaning into specifically the student experience that those operators can provide should be seen as positive, for sure. On the other side of the table, you obviously have build to rent that's potentially more flexible, particularly the Renters' Rights Act, which acts as a somewhat counterweight to that. But again, I think the fact that PBSA is specifically targeting students, they know who their target market is going to be, absolutely. They can lean into that experience more and be more tailored towards the student, whereas build to rent's not necessarily set up to do that. So I think the interplay between those two asset classes is going to be interesting to see.
Yeah.
I think there's a question about
yes,
here as well, maybe.
Sorry, a link to BTR there, Rich.
Yeah, so there's another question we've had submitted, and it was around the topic of have we seen BTR operators' appetite for students change
Mm,
in their schemes? And again, it goes back to the point I just made. I think the reality is for operators where there is enough underlying demand from, say, young professionals, that would be the preferred route. Again, clearly that's the business model for build to rent. For those BTR schemes that are perhaps newly delivered and again want to help facilitate occupancy in the lease up are leaning into students. So I wouldn't necessarily say there's been a change because the changes, yeah, it's always been the case that in an ideal situation you would not be taking students.
mhm.
Um, I think in terms of the exposure to students over the long term, again, that's going to vary depending on the number of beds being delivered within a market. We do know some BTR operators have managed to reduce their exposure to students over time, which again is a positive trend. That's demand that's going back into PBSA and HMOs more broadly. So yeah, so I wouldn't say it's a change in appetite. It's just a natural evolution of the exposure that these BTR schemes have to student. But as I say, if you have a 1,000 unit BTR scheme being delivered into a market that's already either saturated or not, that's going to have a short-term impact for sure.
Yeah, I guess with this as well, though, there's not, a uniform BTR operator kind of approach to this, right? Like,
Yeah,
I know, again, this is purely anecdotal, but we speak to some BTR operators that will report on 20% student occupancy, or some others that report almost 100%. So it's really hard to kind of gauge the exact kind of demand pool there, right?
yeah, yeah. No, exactly that. Yeah, it's not a one size fits all for sure.
Exactly. Yeah. So on to the next question. So while parts of the student market seem to be doing okay, others are well down on numbers. So how many years do you think it will be before the market stabilizes and the numbers begin to grow again? Well,
Yeah.
yeah,
I mean, again, that's the ultimate question. That's we've had
exactly.
questions from those stakeholders we work with in terms of is the recent dip in demand short-lived? Is it something more structural? And I think, to be honest, nobody really knows at this stage. Again, we'll explore this in detail in more recent sessions. The decline in demand, particularly associated with international postgrads, arguably is part of a hangover from COVID. We will see a recovery and a return to growth. The kind of jury's out. We don't quite yet know. I think the other again trend that we've spoken about before is the flight to quality trend. I mean, it's pretty clear that your more prestigious universities, which is not just the Russell Group, but again those with higher entry grade requirements, are much in a much better position to weather any storm when it comes to total numbers. And you see that in the UCAS data, those higher tariff providers taking market share, growing at a reasonable rate. And that does have somewhat of a probably like a trickle down effect for the rest of the market. You know, your more medium tariff providers will take an impact, and then your lower tariff providers are the ones that are going to sit there saying, where all the students gone? Well, they've traded up to go to the best universities. So I think that is a risk for investors and operators exposed to those less prestigious universities. Where are they going to find that demand growth, given, again, higher tariff providers can lower requirements and scoop up that demand if needed. I think one positive, and actually is an interesting potential impact from some of the university mergers, are we going to see some universities take a more specialist route? Obviously, that's already the case with some of them. And again, those that are possibly specializing in certain areas might actually be, again, relatively well hedged against any declines in demand, for example. So, yeah, again, very difficult to say in 2 years' time the market's going to recover and all markets will recover. I think that's probably unlikely. It's very
Yeah.
much going to be, yeah, depending on the specific university and what approach they take. And then you have mergers, which could change the outlook again over the next 12 months or so.
But it's what the people want to hear, Rich. The market will be better in two
Yeah,
years.
they do. Yeah.
I'll probably just go on to one last question. We've had quite a few come in, so we'll maybe put up blog post for the remaining kind of questions that we haven't got onto yet. So, Rich, probably the last one for you is what is driving lower pre-let pace for the next academic year and this cycle compared to historic ones? So,
Uh,
how should investors navigate conflicting data?
Yeah. So I think if you look at the UCAS numbers, the more recent ones, again they're relatively positive. Number of applicants have risen. First thing is that's not the full picture. Obviously, UCAS doesn't cover postgrads, which is where we've seen a lot of the growth and then volatility in more recent years. And similarly, actually, those applicants don't necessarily transfer into acceptances. So you could find a situation where applicants rise, but that doesn't translate into a rise in demand, for example. In terms of the current cycle, again, I'll speak broadly and then we'll maybe focus on some locations. I think if you look at the numbers broadly, then again, we're seeing that supply growth as we've just seen, albeit at a reduced level compared to where we were historically. To offset that supply growth, you need demand growth. So if we are not seeing an increase in the total number of students, and again, live at home rates, changes to international postgrads, all factors, but if we're not seeing that demand growth and supply is still rising, that's naturally going to impact occupancy. You then take that and look at individual locations. As we've seen earlier, again, Glasgow was one of those markets where we are seeing a chunk of beds being delivered into that market. Again, same analogy. If that market is not seeing demand growth and it's static, it's going to take an impact. So I think that's really what's driven some of the positivity in previous years, in that there was supply growth, yes, but it was being more than offset by increases in demand. And the fact that the market has not seen that demand growth in more recent years and supplies continue to grow, that's where we've seen some challenges. So yeah, as I say, we'll have to see how the rest of the cycle plays out. But equally, there will be some markets where we know supply growth is non-existent because planning is non-existent. And in those markets, you would expect a recovery probably more quickly. And again, you wouldn't need much from a demand growth perspective for those markets to recover quickly. So, as always, it will come down to the specifics of the individual market that we're looking at, really.
Yeah, great.
I did see one more question, which was an interesting one because it actually come up in conversation recently as well around rent and revenue, and whether as an industry we do need to move towards more of a kind of RevPAR metric, which is I know what's used in the hotel industry. I mean, anyone that's interested in that as a topic, I'll be really keen to have a conversation because it is something that I'm interested in. I think as an industry, if we had a standardized metric for that, again, similar to what's in the hotel market, I could certainly see the benefit there. So yeah, anyone that's interested in that as a topic, yeah, more than happy to have a conversation. Obviously, our occupancy survey we've been developing for the last 3 or 4 years, and it's been really great to see that continue to grow. So yeah, I think anything we can do to drive forward the level of quality data in the market is going to be beneficial for sure.
Yeah, yeah, for sure. I think we're kind of out of time now, but we've kind of gone through most of the questions. So like I mentioned, any outstanding questions that we haven't had time to kind of go through, we'll put out some communications or a blog post just to kind of wrap up those loose ends. So as a reminder, the recording of the session will be shared. So remember to follow StuRents on LinkedIn, sign up for our monthly newsletter if you haven't already, and then you'll be able to access the trends and insights from us at the intelligence team. So thanks all for joining. We hope to see you all again soon and enjoy the rest of your afternoon.
Thanks, everybody. Cheers.
Cheers.